Assalamu alaikum friends, welcome to question number 25 of SBR revision kit, Cherry. So as you can see, we have some accounting issues. We have changes in accounting policy for pension scheme. That means we have to use IAS 19 here for 3 marks. Then we have trademark. Okay, so trademark is related to intangible assets. That means we have to apply the rule of IAS 38 for 4 marks. Then we have sale and leaseback. This is IFRS 15 for 5 marks. So now let us read the requirements. Discuss the correct accounting treatment of the above transactions in the financial statements of Cherry for the year ended 30th November 2006. Okay. Usually this is in section B. This is the question that they ask. One is correct accounting treatment and number 2 is ethical issues. Okay. So for ethical implications, it's for 6 marks and 2 of the professional marks. Now let us read the background. Cherry is a publicly limited company. It prepares its financial statements using IFRS standards and has reported date of 30th November 2006. A bonus is paid to the director each year, which is based upon the operating profit margin. See, in the background, you'll be given 1 or 2 pieces of information which is very important for your ethical perspective. That's why it's very important that you start by reading the background. Okay. So the important thing is that bonuses is paid based on what? Which measure? Operating profit margin. That means if you see these 3 accounting issues, whether it is change in accounting policy, whether it is trademark, whether it is sale and leaseback, you should see whether it increases your operating profit margin or not, because bonuses are paid on that, no? So they want to show higher profit. So now with that understanding, let us read the first accounting issue, that is change in accounting policy for pension scheme. And pension scheme, mind you friends, it's not easy. Pension scheme is a little bit tricky, okay, this area. So make sure that you understand pension scheme properly, especially the application of it. So on 1st December 2005, there was an amendment to Cherry's defined benefit scheme whereby the promised pension entitlement was increased from. So what was that amendment? They have increased the pension from 10% of the final salary to 15%. This was the increment. Directors believe that the pension scheme which is in deficit is not an integral part of the operating activities of Cherry. Okay? Is not an integral part of the operating activities. As such, they have changed the accounting policy so that from the current year, all gain and losses on the pension scheme are recognized in other comprehensive income. They believe that this will make the financial statements more consistent, more understandable, and can be justified on the grounds of the fair presentation. So make sure when you're writing this answer, even from the ethical perspective, you have to talk about this, because they believe doing this by writing it under other comprehensive income, the gain and losses, it will make the financial statement looks more consistent, more understandable. These are the features of what? Qualitative information. Is it actually making it more consistent? Is it actually making it more understandable? Is a question mark that you need to answer, and can be justified on the grounds of fair presentation for 3 marks. How are you going to get this 3 marks? First mark you'll be getting for using stating what the standard IAS 19 says regarding this change in policy, writing it under other comprehensive income. Second, correct treatment, what they should have done in this case. Third mark you will be getting for identifying the effect of this error on the financial statements, effect of the mistake, the error that they have done on what financial statements. That means what's happening to the profit figure. Is it understated or is it overstated? That's what you need to talk about. Not only in the first one, but in all the 3 accounting issues, you have to go by the same way. First, you apply the standard. Second, you tell the correct treatment according to that standard in the case study. And third, the effect of that error, whether the profit is understated or overstated. Okay, so coming to the first one, 3 marks. Now let's finish that before we go to the trademark, because see, these 3 accounting issues are not related to each other. Even though it's the same company, Cherry, but they're not related. You can answer them in, they are isolated, right? So you can answer in any order. You don't need the information of trademark and sales leaseback to answer this one. Okay, so I will just read and answer this one. So now if I go make sure that you write the proper subheading because there are more than one accounting issues. Okay, so this is change in accounting policy for pension scheme. This you can take it from the requirement itself, the scenario. Okay, remember there are two standards here because they told change in accounting policy. Change in accounting policy is under IS 8. You have to identify a hidden standard under the main standard. Looking at the word pension scheme looks like only IS 19. No, it is a change in accounting policy. So this for change in accounting policy we use IS 8. No matter whatever that accountancy policy is, it could be a change in accounting policy in property, plant and equipment, it could be a change in accounting policy in intangible assets, it could be for any item. But if it's a change in accounting policy or change in estimate or an error, IS 8 needs to be applied. So you start by the rule of IS 8 because the main thing is not pension scheme. The main thing here is change in that accounting policy that is going to lead to error and all. That's why we have to talk about IS 8 first. According to that, how are you going to recognize this change in accounting policy? Okay, so IS 8 only permits a change in accounting policy if the change is, you cannot do accountancy policy as your wish. Okay, IS 8 only permits that change in accounting policy if the change is, you need to mention these 2 points. The conditions under which you can change the accounting policy. Number one, it is required by an IFRS standard that you have to change. Or, okay, or means this or that. One of it should be there. Or results in the financial statements providing reliable and more relevant information. They were telling that it will make the information look more consistent, more understandable. You know, if either of this, then you can change the accounting policy because they feel that if you change the accounting policy, it makes your financial statements more reliable, more relevant. So if it's a change in accounting policy, what is the adjustment? Retrospective adjustment. Retrospective adjustment. That means you go back and change in the past. Your prior period financial statements you change. You do adjustments there. That is known as retrospective. The other word is prospective. Right? That means you go in the future and change. But this is past. You have to go back in the past and change. The meaning of retrospective when it comes to policies. So a retrospective adjustment is required unless the change arises from a new accountancy policy with transitional arrangements to account for the change. If that change arises from new accounting policy, for example, something new came, right? The policy has changed. It's a new accountancy policy. Then you cannot go back and change in the past. Why? Because in the past you didn't apply that accountancy policy. No, it is a current accountancy policy that you have changed. Then only you have to go back and change. But if it's a new accounting policy, you cannot go back and change because it has just arrived. You didn't apply that in the past. So you change the current and the future. Okay, so with transitional arrangements to account for the change. So here, it is possible to depart from the requirements of IFRS and IS standard, but only in the extremely rare cases. Yes, you can depart from this, but only in very rare cases. Okay, this also you need to write your answer because here what they did, they departed from the usual standard, usual IS, that is IS 19. We'll come to that later, but first you need to talk about whenever there's a change in accountancy policy, remember that it is first IS 8 that you have to talk about, then you will be talking about the revenue standard. Okay, so extremely rare circumstances where compliance would be so misleading, where if you comply with it, it would be misleading. That's why in those conditions you can depart from IFRS and IS standard. Because if the compliance is misleading means it will conflict with the overall objective of the financial statements. Okay, this override is rarely, if ever, invoked. Remember, it's very rare situation that this happens. Okay, and if how do you know whether it's happening in your case or not? They will tell you that if you follow this standard, it is misleading and all. If they have not mentioned anything about it, you just cannot assume that this is the rare circumstance. No. But you need to talk about this. Under what conditions you can depart from IFRS. So having this rare circumstance is one of it. And this needs to be there in your answer because you'll be getting 1 point for that. It's 3 marks. So 1 point you'll be getting for telling that these are the reasons that you can depart from IFRS or IAS standard. Okay. Now you will be using the appropriate standard and then you have to tell why that change in accountancy policy is allowed or not allowed. So now we are going to IS 19, and you need to separate this. Okay, this will be in different paragraph and this will be in a different paragraph when you're coming to IS 19. Okay, so here IS 19 requires, so IS 19, what are you exactly going to talk from that? That standard is big enough. It has pension liabilities, pension assets, so many things. What are you going to exactly talk? Whatever is relevant for your case study, that is, they are talking about the gain and losses, that it has been put under OCI. So we only have to talk about this. What does IS 19 talks about the gain and losses? That's it. That's the only part that is being asked from you. So IS 19 requires all gain and losses on a defined benefit pension, which on a defined benefit scheme. Please mention that is a defined benefit scheme, because there are two types of scheme. One is defined contribution, but we don't want to go into that because that's not been asked. On a defined benefit scheme to be recognized in profit or loss. Where do we recognize? Profit and loss, normal way, right? Except for the remeasurement component, which must be recognized in other comprehensive income. Remeasurement means when the fair value, we are changing. The change in fair value, the remeasurement will go to OCI. Otherwise, gain and losses in profit and loss only. So there is an amendment to the pension scheme, no? So now we have to talk about that amendment in the next paragraph. Remember, it's for 3 marks. Don't keep on spending time. So 3 into 1.8, you should spend 5.4 minutes. That means let's keep 5 minutes. 5 minutes only you have to spend on this. So this is a good idea for you to guide how much you need to write. So keep time next to it, that I'm going to spend 5 minutes on it. Halas, 3.5 minutes. You can write in 3 different paragraphs. First paragraph, you will be talking about IS 8. Second paragraph, you will be talking about IS 19. Third paragraph, you are saying what the company is doing and what would be the implications of it. So the amendment to the pension scheme is what? It's a past service cost and must be expensed to profit and loss account. This is the correct treatment. When you're doing any amendment to the pension scheme, it is a past service cost. Let us again read that. Right? It was entitled 10% of final salary to 15%. It is not relating to the future services. It has services has already been given in the past. Now they are just increasing the pension from 10 to 15% of the final salary. So it is a past service cost, that amendment. Okay. So it's a past service cost. It must be expensed to profit and loss account. It has nothing to do with the remeasurement. If it was remeasurement component, then only under OCI. But this is not remeasurement. This is past service cost. So additionally, it appears that the directors wish to manipulate other aspects of pension schemes, such as the current service cost. Right? Directors, they are wishing to manipulate other aspects such as current service cost. And since the scheme is in deficit, you see, you have to talk about this, because the scenario mentions of this, that it's a deficit. So you have to talk about it. So the current service cost, and since the scheme is in deficit, the net finance cost. So what are they trying to do? The directors are deliberately, that means they are knowingly manipulating the presentation of these items by recording them in OCI rather than profit and loss. So this is an issue. Okay. And don't forget that this answers you will need in your ethical answers as well. Ethical issues later on in part B. But when you're answering from accounting perspective, you have to talk in the form of standard, what they are saying and what should be the correct treatment and what you are doing, right? You are just manipulating by recording in OCI rather than profit and loss account. Now we are coming to the trademark. Exactly the same steps needs to be replicated in the trademark. The only thing is the standard is different, that's it. The rules are different. But the way you apply to the case, the way you have to answer, the order which you need to answer is the same as the previous one. So trademark, don't rush into calculations. Easy marks are available for using IS 38 to explain why their treatment of brand is incorrect. Okay. So if you see the next one, it is for 4 marks. Definitely 1 mark extra. That means you need to. Why that 1 mark extra is here? Because here we have numbers, we have to calculate. So that for calculation you are giving 1 mark. Okay. On 1st of December 2002, Cherry acquired a trademark Golfer for a line of golf clothing for 3 million. That means this is the cost of the trademark. They have got it at 3 million. Initially, because of the difficulty in determining its useful life, Cherry decided to amortize the trademark over a 10-year life using the straight line method. On 1st December 2005, this was on December 2002. Now this is on December 2005. After 3 years, just a competitor unexpectedly revealed a technological breakthrough which is expected to result in a product which they launched in May 2008 will significantly reduce the demand for the golfer product line. So what is it? These are sign of external indicators for impairment. Your intangible asset is impaired. So these are some signs, external factor you can say. Cherry now intends to continue manufacturing golfer products until 31st May 2008. Amortization of 300,000 in relation to golfer trademark has been charged in the financial statements for the year ended 30th November 2006. So you need to talk about the correct treatment of amortization, whether it is correct or not. So you have to use which standard? IS 38. So here, number 1 point is about the finite or indefinite, that useful life we have to talk about. Okay, useful life. So IS 38 states that an intangible asset with a finite useful life should be amortized. Finite means you will be having 10 years, 20 years. You can predict that this is the useful life for the intangible asset. Then if you can predict that useful life, you amortize it. You should amortize it on a systematic basis over that life, over 10 years, 5 years, whatever it is. Okay. So the first paragraph, they are talking about that only, useful life and amortization. Okay. The amortization method should reflect the pattern of benefits and it should be reviewed at least annually. When you're doing amortization method, it should be reviewed at least annually. Okay. Make sure that these points are there in your answer. I'm just highlighting the keywords. Sentences you make according the way you want to. Okay. You're free to do that. You don't have to exactly write word by word. It's not possible. You cannot, come on, you cannot memorize all these answers. How many questions are there in your SBR kit? 64 questions from revision kit. How do you expect to memorize all the answers? Unless you are a robot or some extremely genius or an genius level or something, which is a very rare case. Only maybe 0.001% students will do that. But again, I will never suggest memorizing answers. So know the keywords that needs to be there in your answer and you can make up the sentence having these words in your answer. So a change in amortization method is adjusted prospectively. Earlier, what was it in your this thing? Change in accounting policy. It was retrospectively we changed. Right? Here, it is prospectively we are changing. Why? Amortization method. What is this amortization method? Is it a change in accounting policy? Is it an error? Is it a change in accounting estimate? You need to first identify that. Based on that only. This is a estimate. Amortization method, depreciation method. These are estimates because this you are estimating these things. Depreciation, amortization and all. They are not known as change in accounting policies. Okay. So if it's an estimate, you prospectively change, adjust. That means you don't go in the past and change. You change the current period that the change is happening and from there onwards in the future, you'll be changing it. Okay. That's why the word prospectively is important here. Relating to amortization because it's an estimate. Okay. So a change in amortization is adjusted prospectively as a change in estimate under IS 8. Okay. Now, we are coming to the second paragraph. What the second paragraph talks about? We'll see. So expected future reductions in sales could be indicative of a high rate of consumption of the future economic benefits embodied in an asset. Okay. Hence, the trademark should have been amortized over a. So these are some facts that are using from the case study itself. The trademark should have been amortized over a remaining 2.5 years, starting from 1st of December 2005 until 31st May 2008. Okay. Next, at the date of the estimate change, the trademark had a carrying amount of 2.1 million. because 3 million was the cost and into 7 over 10. Why 7 over 10? You deduct your depreciation. Depreciation for 3 years you have to take. 2005, 2006, 2007. Sorry, it's 1st of December 2005, right? So 2006, just wait a minute. We'll go to that depreciation again. So you took it for 2002, right? 1st of December 2002. So from 1st of December 2002 till 1st December 2005, 3 years went by. Okay, 3 years went by. So that means 3 over 10, that depreciation you have to deduct. So the balance after deducting depreciation will be the balance 7 over 10. That's why you're multiplying this 3 million by 7 over 10. That is the cost. Okay. So it will be 7 over 10 into 3. This will be the carrying amount at the date of the estimate change. So the amortization charge in the current period should have been 0.84 million because they charge 300. Remember, it should have been 0.84 million. How? Because this is the carrying amount 2.1 divided by 2.5 years. Because from 1st of December 2005 until 31st May 2008, it's 2.5 year. Okay, which will become 0.84. But you have taken 300,000, which is less than this 0.84. That means you have taken less amortization. Less amortization means your profit is overstated. So this means that Cherry's profit and intangible asset both are currently overstated. This is what you need to write in every issue. Which one is understated or which one is overstated? Here both are overstated. Profit is also overstated. Intangible asset also overstated because intangible asset you deduct amortization from the carrying amount. But if less amortization you are deducting, higher intangible asset. So both are overstated. How much? Actual amortization should have been 0.84, but you have taken only 0.3. So the balance, it is amortized, it is overstated by this amount. Now you are correcting the entry. When figures are given to you, you can easily show journal entries. Okay. The correcting entry is you debit the amortization expense. That means expense will go up and intangible asset will go down because of the amortization expense. So that's why you credit intangible assets. Now we are talking about the impairment. Remember, another standard needs to be applied to IS 38. That is impairment. When impairment happens, this could be for any asset. It could be a financial asset, it could be an intangible asset, it could be a property, plant and equipment, anything. When impairment is there, you have to use IS 36 with that, along with that standard. So IS 36 is the next standard after IS 38. So here three standards we are using: IS 8, IS 38, IS 36. IS 8 is for the change in that amortization, IS 38 is for the intangible itself, and IS 36 is for the impairment part. Okay. So what does this say? This say that they should assess annually whether there is an indication that the asset may be impaired or not. They have to look for these indicators. That also every year. So if any such indication exists, the entity should estimate what? The recoverable amount of the asset. So does Cherry mention the name of the company? Cherry should test the trademark for the impairment. That trademark they have to test for the impairment, whether it is impaired or not, by comparing its carrying amount to its recoverable amount. Okay, and now you have to talk about the recoverable amount. How are you calculating that recoverable amount? It is the higher of fair value less cost to sell and value in use. Okay, if the trademark is impaired, then the current over. See, you don't have to find the impairment of assets because they have not given you the figure. They have not they didn't give you the fair value less cost to sell nor value in use. So you cannot determine the recoverable amount. Okay, you are only given the carrying amount, but you don't have the recoverable amount. So you don't have to calculate, but you have to write. But you have to compare this with the recoverable amount if the impairment is there. And if the trademark is impaired, then the current overstatement of Cherry's profit and asset is even greater. If the impairment is impaired, that means whatever is there, that profit is overstated and asset is also overstated. Because that impairment you didn't include, no? If it was originally impaired but you didn't include it, so profit will be overstated again and asset is also overstated. Coming to the third issue, sale and lease back, IFRS 15. And this is also a tricky area, it's not easy. Students get confused with the sale and the lease back. They try to combine the two things because they think sale is IFRS 15 and leases are your IFRS 16. They combine this two. No, it's not like that. You need to combine, but you need to understand what is sale and lease back. And when it is a sale and lease back, you need to identify whether that is a sales transaction has happened or not. If the sales transaction has happened, then you use IFRS 15 to that. Otherwise, you don't. So that's exactly what we need to do in this also. But let us read the scenario first before we decide anything. It's for 5 marks. That means this gives you an idea that you have to write more on this part than the previous two. You have numbers also. I can see some numbers also there. So that means some calculations you have to do. Cherry sold a building for its fair value of 5 million to a finance company on 30th November 2006 when its carrying amount was 3.5 billion. They sold a building. Fair value 5 million, carrying amount was 3.5. That means they are making a profit. The building was leased back. Now they sold the building. Now they are using that building again on lease. To whom they have sold that building. Now they are using that building from them, but under a lease. They are not buying it completely, but they are using it under the lease. So the lessor becomes the lessee and the lessee becomes the lessor. That's what is happening here. So the building was leased back from the finance company for a period of 5 years. This 5 years is the lease term. The remaining useful life of the building was deemed to be 25 years. So that it can be concluded that the control of the building has transferred to the finance company. Control of the building went to whom? Finance company. So when you are taking on a lease also, that building is not coming back to Cherry, okay? It remains with the finance company only, but you are just using it over the 5 years. Lease rentals are 440,000 payable annually in arrears. So you have the lease rental annually. The interest rate implicit in the lease is 7%. This they will give you. This figures they will give you the rental, the rate, present value also they will give you. Okay. Most of the people ask me this question whether we have to find the present value of the lease payment or not. They usually give. Okay, you don't have to calculate by using discount and all those things. They will give you the figure itself. So you don't have to find the present value. That's a good thing about IFRS 16. So the present value of the annual lease payment is 1.8 million. Cherry has recorded the cash proceeds. Okay. Because he have sold the building first time. So that time he recorded the cash proceed. Because he sold the building, he de-recognized the building. Because anyway, the control of the building went to the finance company, right? And he recorded a profit on disposal of 1.5 million. Because he sold it for 5 million and the carrying amount that time was 3.5. So the difference is 1.5 billion. So he recorded that profit in the statement of profit or loss. No other accounting entries has been posted after that. That means when he sold the building for the first time to the finance company, that time he did everything correctly. But when he leased it back again from the finance company, those accounting entries he didn't post. Those you need to do it because it's incorrect to not include that lease part. So the directors have told the financial controller that the accounting treatments outlined above are correct. Any further time that the financial control spends reviewing this transaction will be looked on unfavorably when deciding the bonus for her. This is like he's threatening the financial controller that if he spends more time in reviewing that is it correct or not, then her bonuses, it's going to be unfavorable for her bonuses. It will have an impact on the bonuses. That means he might not receive the bonus, the financial controller. So this is an ethical perspective, ethical issue that you need to address in your ethical issues. So now we are coming to the sale and leaseback. Remember that the lessees are required to recognize. Who are recognized? Who should recognize what? That is also important. You should know both the lessor accounting as well as the lessee accounting in order to answer well in this part, sale and lease back. So lessees, the one who have taken that lease, who are using that asset under a lease, they recognize right of use asset because they are using that asset, and also a lease liability because they have to make a payment to the lessor. Cherry has not done this. Did he do? Who is Cherry? Cherry is a lazy. First identify who is Cherry. Is he a lazy or a lazy? He's a lazy because he is using that asset from the finance company and he has to make a payment. So he's a lazy. What should he recognize? Right of use asset as well as a lease liability. But he did not recognize any of it. So if you comment on this, this will give you some easy marks. And also the calculation of the correct profit on disposal is trickier. Revisit the study text if you cannot remember how to do this. So make sure that you, in my video channel I've uploaded IFRS 15 sale and lease back. So make sure that you watch that video to understand this better. And also you can watch my IFRS 16 also to understand leases better. Okay. So sale and lease back transaction. And this sale and lease back things come under IFRS 16. Okay. It's not under IFRS 15. So sale and leaseback transactions are accounted for under which standard? IFRS 16. But sometimes you have to use a IFRS 15 also if it is proved that the transaction is a sale. Okay. So if the transfer of the asset represents a sale, very important, I told you previously. If the transfer that you have done to the asset, if it's a sale, then the seller lazy. Who is the seller? The lazy is the seller. Usually lazy is the buyer, but in this case, he is the seller. He measures the right of use asset. Okay, that means the lazy. He measures the right of use asset at the proportion of the previous carrying amount that relates to the rights retained after the sale. So when he is measuring the right of use asset, how is he taking? He is taking the proportion of the previous carrying amount that relates to the right that he has retained, that he has not sold. So this means that the seller, the lessee, recognize a profit or loss based only on the rights transferred. So for transferring that right, he will recognize the profit or loss. Who will recognize? Seller. The lessee will recognize that. That is Cherry. Cherry is the lessee, no? Not the finance company. Now, second, you have to explain both. Okay, what if it qualifies for sale? What if it does not qualify for a sale? If the transfer does not qualify as a sale, then the seller lessee continues to recognize the underlying asset because it's not a sale, no? So he will continue to recognize that asset. He will not de-recognize. And will also recognize a financial liability equal to the proceeds received. This is important. Because, okay, if you're not understanding this part, make sure that you go in depth. I have explained this in my IFRS 16 sale and lease back. Why financial liability is recognized and all. Okay, because this is a rule that if it does not qualify for a sale, you recognize the asset also, and also you recognize a financial liability equal to the proceed that you have received. Okay. So in this case, it would seem that the transfer does represent a sale. In this case, it looks like it's a sale, does represent a sale. Why? Because Cherry is only leasing the asset back for a fraction of his remaining useful life. He's only leasing the asset back for a fraction of his remaining useful life. His useful life is 25 years. Out of 25 years, only 5 years. 5 years is leasing it back. Only a proportion. So that means the sale has taken place. And so the buyer, the lessor, that means the finance company, seems to have obtained the control. They have obtained the control of the underlying asset. Because usually when a sale takes place means the customer, the one to whom you are selling, in this case the lessor, the finance company, he has the control. So Cherry, now you know that it's a sale. Now you start calculating. So Cherry must initially measure, but with calculations you have to explain also that you are doing this. This should be measured at this amount. This should be measured at that amount. This should be recognized at this amount. That you have to write it and then you have to calculate with that. Okay, along with it. So Cherry must recognize the right of use asset because he's a lessee. At what amount? 1.26 million. How did they get 1.26 million? 1.8 divided by 5 into 3.5. Did you understand? Okay. So 1.8 divided by 5 into 3.5. Now, remember, we have told here, go back. How are you recognizing the profit or loss? Proportion of the previous carrying amount that relates to the rights that are retained after the sale. Okay, so here, if we go back, what was the previous carrying amount? 1.8. Okay, first of all, this is the present value of the annual lease payment. Right of use asset, when you're recognizing it, okay, how do you calculate right of use asset? It is present value of lease liability plus all the direct cost and everything. But here we have not been mentioned about any cost and all. So whatever is our lease payment, the present value of lease payment is only a right of use asset. That is the carrying amount of right of use asset also. Okay. Don't take this 3.5 million now, this carrying amount. Wait. You have to take the proportion of it. So 1.8. Okay, let me write it here. So this 1.8 is the carrying amount of the right of use asset, okay? Present value of liability. Divide by 5 years. Why? Because the lease is for 5 years. Multiply this by what? You have to take the proportion of the carrying amount, the previous carrying amount. That means this 3.5 that you are having. Because you are not recognizing the asset. 3.5. Hence, okay, so this is how you calculate. This is the method you calculate, okay? It's a fixed method. 1.8 divided by 5 into 3.5. Hence, it is 1.26. Initially, you're measuring the right of use asset like this. Now, so lease liability is at 1.8 million only. It is given. Initially measured at the present value of the lease payment. It is already given to you. Now, this is just the copy paste of this, okay? This is this line only. So Cherry has recorded a profit on disposal of 1.5 million, right? That's what they have done, right? So, but there should have been 0.96 million. That profit figure is wrong. Now you have to correct that profit because this is a sale. So how are you going to get that? They have sold it for what? They have sold it at a fair value of 5 million. 5 minus 1.8 because this is the right of use asset. Don't compare it with 3.5. No. You have to compare it with 1.8 because right of use asset. That is a carrying amount of the right of use asset. You deduct it from 5, the sale proceed, and divide it by 5, the sale proceed. And you multiply this by 1.5, the profit that you are getting it. Because you have to take the proportion of the profit. You cannot recognize the entire profit on disposal because you have leased it back also again. It's correct that it's a sale, but you leased it back also. That's why from this 5 million that you have sold it off, you are only minusing 1.8, the carrying amount of right of use asset. You're taking the proportion of this 1.5 billion. So only 0.96 profit you can recognize. If it was a normal sale without a lease back, it will be 5 minus 3.5, normal 1.5 only. But there has been a lease back also. That's why we are minusing this 5 million, the proceed with the 1.8, the carrying amount of the right of use asset, dividing it by 5. Because we want to find the proportion of that, rights retained, into 1.5, the total profit, hence 0.96. Therefore, the profit on disposal must be reduced by 0.54 million because 1.5 minus 0.96. You should reduce the profit. So when you are writing the correct entry, right of use asset will go up, debit 1.26. You have already calculated here. Profit and loss will go down, so you debit, and lease liability as it is given 1.8 credit. Make sure when you're writing the entries through a journal entry, your debit side should equal to your credit side always. So here if you add this to 1.26 plus 0.54, it is equal to 1.8. Hence credit side is also 1.8. If it's not matching, that means your figure somewhere is wrong. Either your debit side or credit side, you need to check again. Okay, always you need to check. Now, because you have recognized right of use asset, please don't forget on one thing, that is depreciation. Depreciation, very important. Most of the students, they ignore, they forget about depreciation. They stop till there. So 1 mark you'll be missing out if you don't write about depreciation. But It is in the next reporting period because depreciation you record after a year, not immediately when you recognize the right of use asset. So in the next reporting period, depreciation on the right of use asset and also the interest on the lease liability, these two things, will be recorded where? In the profit and loss account, right? Depreciation is an expense, interest is a finance cost, profit and loss account. So it will further reduce your profit in the next reporting period. So that's it. Now we are going to the ethics part of this. Since we have already read the requirements, the case study, we don't have to spend time again to go through it. We know what are the ethical issues. For example, the first one talks about the changes in accounting policy regarding the pension. So we know this should have been recognized in profit and loss account, but it was recognized in OCI. Coming to the second one, intangible assets. Amortization, they have taken less amortization. That means profit they have overstated. Third one, sale and leaseback. They took more profit, but the profit should have been less. So profit is again overstated. Okay. So now, when you're writing ethics, you have to write which ethical principles are being breached, what are the actions that the accountant should do, and also you have to relate to these three accounting issues. That's how you're going to get the 6 marks. And the 2 professional marks you will get by following the structure, by giving the recommendations, the practical recommendations to the accountant that they have to do. Okay. Make sure that you discuss why the directors are behaving unethically. This is very important. When someone is behaving unethically, don't just write directors are wrong, they should have not done it, they are being acting unethically. Come on, everyone knows they are acting unethically. The question is, why are they acting unethically and what is the impact of that? That you need to write in your answer. And which accounting principles are being breached. That's what you need to write in ethics. You don't have to write he is unethical or not. He's definitely unethical. But you need to write why he's unethical, what are the accounting ethical principles that are being breached. Okay. So it's for 6 marks. Okay. Don't write paragraphs and paragraphs for ethics. You don't have time. Straight away link to the 3 accounting issues. So the correct accounting treatments cannot be justified. All the 3 accounting treatments, all the 3 issues, it cannot be justified. The directors have an ethical responsibility. You have to talk about the ethical responsibility of the person who is breaching this. Any ethic question, you need to write this way. Okay. So the director have an ethical responsibility to produce the financial statements which are fair representation. This word, keep them in mind. Okay. Fair representation. They have this responsibility, ethical responsibility of the entity's performance and position and which comply with all the accounting standards. This is very common. This 3-4 lines you can copy paste it in your ethics and you can write it. Same thing. That person has ethical responsibility. Accounting treatments are not justified. They have to comply with all accounting standards. These are always repeated. But after beyond that you cannot copy paste because it is specific to the scenario that you have been given. Okay. So the errors made by Cherry. What is the impact? It understates its liabilities. Liabilities are understated and it overstates assets and profit. Let us again go to understand this better. In case it's not coming in your mind right now, it's not flashing in your mind how profits are overstated. Let us start with the first one. First one, it was recorded in OCI, but it should have been recognized in profit and loss. The pension changes and all. That's why profit is overstated. Right? Profit is overstated. Coming to second, trademark. So in trademark, what's happening? Amortization expense. So your asset you see is overstated, your profit is also overstated. Coming to the third one. Third one, if you see your liability is understated because you are not recognizing that lease liability, 1.8 million. That is understated. Profit is overstated because you are recognizing more profit and asset is also overstated. Definitely asset is not overstated in the third one. It is liability is understated and profit is overstated. Okay. So when you're writing ethics answer, another thing, don't just write that first issue, this is overstated, that is understated. Second issue, this is understated, overstated. Third issue, this is understated. No, don't write line by line like that. It wastes a lot of time because you are just repeating the same thing. Rather than writing, you can combine and write together in one line only. That whatever the errors they have made, it understates liabilities, overstates assets, and profit. That's it. Rather than writing three separate sentences for three separate issues, saying this is overstated, here profit is understated, here assets under. Don't write like this. Trust me. It's only for 6 marks. It will not give you 3 marks there writing it. Rather write everything in one line because they are following same thing only. Everything is same. In everywhere assets are overstated, profits are overstated, liabilities are understated. Okay. So now you have to talk about, this is in the second paragraph, okay? Sorry, first paragraph. The treatment and what the errors are doing. Second paragraph, you are talking, linking this, which ethical principles are breached. Okay? And what is the thread? So this, there is a clear self-interest thread. You have to identify that, which thread out of the 5. Remember, when you're answering ethics, remember the thread. 5 types of thread: intimidation, familiarity, advocacy, self-review, and self-interest. This is self-interest thread because his decision is based on the bonuses that he's going to receive. He has a bonus, financial interest. So it is a self-interest thread arising from the bonus scheme. It's not enough to just write self-interest thread also. You have to write why self-interest thread, because it is arising from the bonus scheme. This is the reason why it's a self-interest thread. Link it to the bonus part. Now, so the directors change in policy with regard to pension. Remember, we are telling why they are behaving unethically. Okay. So if you pick up out of the 3 from any accounting issue and explain that this is the reason, you will get the marks. You don't have to write for all the 3 issues. That in this, their motive is this. In the second accounting issue, their motive is this. In the third accounting issue, their motive. No. Whatever it is, whatever accounting issue, they only have one motive. That's the reason why they have made errors in all the 3 areas: pension, amortization, and lease. So the finance director change in policy with regards to pension, because from profit they have put it in OCI, appears to be motivated by what? Intention to overstate operating profit to maximize their bonus. This is the reason they are acting unethically. They want to maximize the profit to maximize their bonus. They have that intention. Now, state the specific principles from the ethical code that the directors are breaching. You need to write it. Any ethics question, this has to be there. Which ethical principles are being breached? There are 5: objectivity, integrity, confidentiality, professional behavior, and professional competence and due care. Out of this 5, which one is breached? Okay. So such treatment is against the ACCA's ethical principles. What is it? Number 1, objectivity. They are not independent. Whatever the decision they are taking, they have to take care of their bonus. So they are not independent. They are biased. So objectivity. Number 2, integrity. They are not being honest. They are dishonest. And professional behavior, because such treatment, whatever they are doing, will bring a discredit to their profession. It is not expected of them being an ACCA member. The directors are doing these mistakes. So professional behavior. Just see, professional competence and due care and confidentiality does not come here. Okay, don't write all the 5 ethical principles. Whatever is breached in that specific case only you need to write. Confidentiality, they have not mentioned anything regarding confidentiality. Okay. And professional competence and due care comes into the picture when the directors are unaware, or they don't know, they are not competent enough, they don't have the knowledge of the IFRS. Then you talk about the professional competence and due care. Okay. But this too, they're mostly this two, it comes objectivity and integrity. Mostly in any ethical questions you see the trend, these two are almost breached always. I'm not saying 100 always this two only will come, but most of the time, right? Integrity you can link with anything, because if you're not honest, you cannot be objective, you cannot be following the professional behavior and all, no? So yeah. Now we are talking from the point of financial controller. What is the ethical dilemma that he's facing? You need to write it. So the objectivity of the financial controller is also being compromised. It is not the director, but even the financial controller. You have to talk about the financial controller as well in your answer. Okay, ethics is from the both point of view. For the director, he knows he's breaching, so he's unethical. Financial controller, if he listens to what director is saying, he is also being unethical. So his objectivity is also being compromised. He is also not being independent. So the implicit threat. What is the threat? The threat to reduce our bonus. would seem to give rise to both self-interest and intimidation threat. Whatever here we have wrote, okay, this means that director's treatment is breaching objectivity, integrity, and professional behavior. Now when we are talking here, we are talking from the point of accountant. Okay, he's facing, what are the threats that he's facing? One is self-interest, because bonuses, it is linked with bonuses. It is being told that if they don't do what the finance controller is telling, sorry, if the director is telling, it might reduce their bonus, or they might not receive that bonus at all. And intimidation threat, because intimidation threat means directors pressurizing the financial controller. Okay, that is known as intimidation threat. Out of the 5 threats, okay, so what are the things which are important in ethical answers? Let me write it here. 5 ethical principles. Just wait. Write it more clearly. Just so number 1, out of the 5 ethical principles, which one is breached? Every ethic answer needs this. Number 2, this is for the person who is doing such accounting treatments. In this case, this is the directors, mostly the person who is dominating or threatening. Okay, directors. First, you have to talk about the directors, why they are doing. Second, why directors or whoever the person in your case study are unethical, or they are following that what they are doing. For example, he has the intention to increase profit for the bonus. Number 3, the 5 threads. Out of the 5 threads, which one? The scenario is giving rise to which thread? One is self-interest, the other one is intimidation threat. This is relating to the person who is being threatened. For example, in this case, it is the financial controller. It could be an accountant, financial controller, junior manager, new employee, anything, right? In the scenario. Number 4, actions. What they need to do. You're telling the accountant, this is for the accountant, you're telling what they have to do because of this threatening and all. Okay. But before reaching this also, number 1 has to be this actually. We'll change this thing. Number 1 has to be you're giving a responsibility, ethical responsibility of directors as a member of ICC or anything. So first paragraph, you'll be writing about ethical responsibility. If you follow these 5 steps in ethical questions, I guarantee you that you are going to get the full marks for ethics. You will never go wrong. Number 1, ethical principle. Number 2, 5 principles, out of it which are breached. Number 3, you have to link this. Okay, when explaining which ethical principles are breached, you have to link this. You have to link this to the accounting treatment, the incorrect accounting treatment which has been breached and all this. You have to link with this. For example, we have talked about pension and all. They have done it in order to increase profit and all. So you have to link it, and then you have to say these are the accounting principles that has been breached, ethical principles, sorry. Okay, so actions also, when you're giving to the accountant, follow the steps. Talk to the person who is threatening you. In this case, this is the director. Then talk to others. For example, audit committee or non-executive director, whoever is in the corporate governance. Then take legal advice or professional help. Okay, ACC help and all you can take. And finally, resignation. When you're giving actions, you have to make sure that you follow the steps 1, 2, 3, 4, 5. Okay, now let us read the last paragraph. Now it should make some sense. So the financial controller should remind the directors. You see, talking to him personally, that should be your first action. Don't say go and resign. So they should remind the directors of their ethical responsibilities and should persuade them to change the correct the current accounting treatment for all of the three of the transactions. If she feels she cannot discuss this with the directors, then she should discuss the matters with the audit committee. The finance controller should document her discussions. You can write more than this, whatever I've explained here. Okay, follow this. Here they didn't write it full because the marks are less. It's for 6 marks. Okay, so let's see the marking scheme, how the marks are distributed. We are over with question number 25. Here the marks are already given, so we know. But coming to this one, discussion of ethical principles are 2 marks. One is what was it? One is objectivity and those things. Okay, the ethical principles. Okay, for example, the 2 marks is for what? Talking about principles. And how you are applying it to the scenario is 4 marks, double of it. So application matters a lot. Okay, and 2 professional marks, they don't say how, but it is based on the actions that you are giving and also the structure that you are following. How you start your answer, how you end your answer with. In the middle part, what do you do? How do you link this with the accounting issues? Okay, so that's it for question number 25. We are left with one more question in section A, that is your question number 2, where we have an ethical question, that is question number 26. After that, we'll be moving to section B, that is your question 3 and or 4, both are 25 marks. Okay, there will be covering current issues and questions like that, conceptual framework, current issues, exposure draft, management commentary, all those stuff will be covering in question 3 or 4, that is in your section B. So take care till then and see you in the next video.